This presentation will report on IOI Group financial analysis. Next slide. So first, I'll report on two-year financial ratio analysis of IOI Group. The gross profit margin had just a slight decrease. The revenue had a significant increase, and so did the gross profit. The net profit margin had increased as both the revenue and net income had significantly increased. The return on equity had doubled in 2021 due to the double amount of net profit, and only a slight increase in shareholders' equity. The asset turnover had a slight increase in the year 2021 due to the increase in both revenue and average total asset. The current ratio in 2021 had highlighted that IOI Group is using every 1.06 ringgit of current asset to pay out every 1 ringgit of the current liabilities. The quick ratio had also dropped significantly in 2021 as the current liabilities had increased dramatically. This indicates that IOI Group could only use every 80 cents of liquid current assets to settle every 1 ringgit of the current liabilities. The trade receivable collection period had increased in the year 2021 due to a high amount increase in the trades payable and revenue. This indicates that IOI Group requires more days to collect payments from its debtors. The trade payable payment period had decreased slightly from 41 days to 32 days due to the increase in cost of sales. This suggests that IOI Group had less time to make payment to the creditors. The leverage had been maintained, and it is almost the same due to the slightly increase in both the total liabilities and total assets. The proportion of liabilities is less than half of the assets for both years. The interest cover had increased due to the increase in profit before interest and tax in 2021 and decrease in finance cost. The dividend yield has a slight increase in 2021 due to the increase in dividend per share. There is a significant increase in earning per share as it has increased by more than double. The price earning ratio had a dramatic decrease due to the increases in earning per share. This indicates that investors of IOI Group had lost some of their confidence in the share price of IOI Group and less willing to invest.
Next, we will look at the 5-year trend analysis of the IOI Group. For profitability ratio, we're looking at the net profit margin. As you can see, there were significant increases from 2017 to 2018. This was likely due to their property development division, which generated 3.71 billion RM and 1.18 billion RM in revenues and operating profits in 2017. Their property investment division, as well as their leisure and hospitality division, also contributed to this. We also see that there was a dramatic drop from 2018 to 2019. This was likely due to lower crude palm oil and palm kernel prices at that time, in addition to lower net foreign currency translation gains on their foreign currency denominated borrowings and deposits. For liquidity ratio, we're looking at their current ratio. As you can see, 2017 is the only year that they fell in the healthy range, where the company will be in a good condition. This is considered as 1.2 to 2. From 2018 to 2020, their current ratio was above the healthy range. This may be because they were inefficient in using their current assets. And in 2021, they were below the healthy range. These significant increases from 2017 to 2019 may have been due to the fact that they tried their best to reduce their debts and improve their earnings for downstream businesses. They also sold their assets, which were worth 3.8 billion ringgit. Next, we will look at inventory turnover for efficiency ratio. As you can see, generally, they experienced an upward trend, except from 2019 to 2020. From 2017, they went from 67 days to sell their entire inventory to 47 days in 2021. This could imply that they had strong sales or possibly insufficient inventory. But overall, it can be said that they had a good inventory turnover. Lastly, we'll look at, actually not lastly, leverage is long-term solvency ratio. Generally, we can see that it was actually quite consistent. Apart from 2017, where they were 0.57, from 2018 onwards, they remained in the 0.4 range, and their liabilities were less than half of the assets during that time. This was likely due to the numerous projects that IOI had invested in at that time. Lastly, we'll look at their price earning ratio. As you can see, it was quite low and inconsistent. It was not stable. Throughout all the years from 2017 to 2021, it was below 0.5. There was also a significant decrease from 2017 to 2018. Then they experienced an increase from 2020 to 2019. And from 2020 to 2021, there was yet another drop in their price earning ratio.
Okay, next is about the 5-year trend of Genting Plantation. The net profit margin of the Genting Plantation had decreased drastically in 2019. This shows that their ability is not strong enough to generate for every ringgit of sale. The potential reason that caused to decrease is the decrease in operating profit. The operating profit leads to other sectors such as selling and distribution costs, administration expenses, and other expenses. The comparison between Genting Plantation and IOI in net profit margin is that the IOI group has better performance than Genting Plantation. The IOI group has higher highs and higher lows. However, Genting Plantation has a higher net profit margin than IOI in 2021, which shows that Genting Plantation can compete with IOI group in the next following years. Next, for the current ratio, IOI has the higher current ratio than Genting Plantation, which is 3.92 in 2019 and 3.33 in 2020. However, in all 5 years of trend analysis, Genting Plantation seems to be more stable than IOI because IOI's lowest record is 1.06. So Genting Plantation has 2.42 in 2018 as the lowest. Although having more current assets to pay off the current liabilities is preferable, but it is not as good as it is because a company with a current ratio between 1.2 and 2 is normal. However, based on their current ratio performance, they are mostly above 2, and both companies may be unable to use their current assets efficiently. Next, inventory is lesser the better in days. Genting Plantation has the highest record to sell the inventory on hand in 64 days, while the least number of days is 29 days. In the IOI group, it has the highest record of 67 days. Also, 47 days is the least. To compare both records in 2021, Genting Plantation has better performance because it is 18 days lesser than IOI. This means Genting Plantation can sell its inventory on hand faster than IOI group. Meanwhile, the higher the times in inventory turnover, the more times a firm has sold and replaced goods within the financial period. To compare both companies, Genting Plantation has the highest inventory turnover, which is 12.83 times, and IOI's highest is only 7.9 times. In conclusion, Genting Plantation has better performance because because Genting Plantation has better performance because it has 5.03 times more than IOI to sell and replace their inventory in the 2021 report. Next is the leverage. The highest leverage of the Genting Plantation is 0.46 and maintain the lowest leverage at 0.4 for 3 years continuously. The sign of maintaining the leverage is good because the company can manage its debt, equity, and assets equally. The maximum leverage is 1, so we can tell that Genting Plantation leverage is balanced. On the other hand, IOI's highest leverage is 0.57 and the lowest is 0.42. When it comes to comparison, it appears that Genting Plantation has better management on leverage than IOI. Because the gap is smaller between the 5-year trend, an increased leverage equals more debt, which is riskier for the firm and its investors. However, if the firm can create a larger return than the loan interest rate, the debt may be served to boost the growth. On the other side, too little leverage might cause concerns such as the company's incapacity to borrow the loan. Lastly, the PE ratio indicates the dollar amount an investor is willing to invest in the firm to earn 1 ringgit of the firm's earnings. The highest PE ratio in Genting Plantation is 0.61 compared to 1, and the lowest is 0.17. This indicates the trend is moving downwards, but the lower the PE, the better it is for both the business and potential investors. Compared with the IOI group, it has a better performance for the shareholders and investors to overlook the ratio. The reason is that IOI's highest PE ratio is 0.45 in 2020 and 0.09 in 2018. Both results were lower than Genting Plantation. As a result, it may signal that IOI is performing exceptionally well in comparison to its historical trend.
For the recommendation and conclusion, the current ratio of Genting Plantation shows a much better result of 2.98 to 1 compared to IOI's ratio, which is 1.06 to 1 in 2021. The Genting Plantation shows that it is capable of paying its current liabilities way faster than IOI Group. The price earnings of Genting Plantation and IOI are both equal as of 2021, but other ratios shows Genting Plantation outperforming IOI Group in other departments of the company. In conclusion, IOI is not a suitable investor choice compared to Genting Plantation. Genting Plantation outperforms IOI in most of the ratios tests performed to evaluate the company's performance. Genting Plantation also has a higher current ratio than IOI Group, which indicates that it is much more capable of paying its current liabilities faster than the IOI Group. According to the data given in the ratios, Genting Plantation proves to be a healthier and promising company than IOI Group. This can generate high profits and maintain the company's overall health.